Alli, I will start with you. Are you surprised at the market's reaction? Relatively complacent. I know we had a sell-off on Friday as well after the events overseas in the Middle East on Thursday night, but down 0.5% doesn't feel like much for what feels like a very serious geopolitical event.
Not particularly. I think none of us wanted to start the year with this as an overhang, but we do view this as a bump in the road and a flare-up where the base case is that we get back to what we've been focusing on: earnings, accommodative Fed, and where phase one ends up. And I think we'll see that in a couple of days. You have a typical reaction from safe haven assets, especially in a time where there's not a particular opportunity cost for holding commodities, with real rates being at zero and a banner year next year. But the market continues to force us all into risk assets.
We mentioned at the top of the show, Alli, that gold is hitting around 7-year highs, looked at again, presumably as a safe haven in a day when we have a lot of turmoil. Is that something you would be interested in adding to portfolios at this point?
So we always believe that you should have a part of your portfolio in gold. Some private clients do that through actual physical ownership. Some do it through gold bugs. But this, at this point, especially with a year that we think is going to be dominated by geopolitical tensions, U.S. election, et cetera, even when we have this behind us, gold has a lot of room to move up. We still think it has gone past that 1552 number that it didn't seem to be able to get through September last year. And we just see everything from the U.S. dollar starting to weaken and become a tailwind, continuing to support it.
Diana, we've seen oil move up, gold move up, of course, we just mentioned, and the yield on the 10-year move down a bit. Is that move done, in your opinion, in terms of a response, at least to where we stand with tensions with Iran?
Well, it depends on what we get next. And I agree, I think the reaction in equity markets so far has been fairly muted, but that's reasonable given we don't know what's going to come next. I think for us to determine whether treasuries keep rallying, we need to see what the response is going to be from Iran. We haven't seen that yet. And markets actually have been here in the past, whether you think about the situation with North Korea, which at some point looked like we were about to go off the cliff, and yet both sides managed to rein us back from actually going into full escalation. So I think at this point it's reasonable that markets are not yet overreacting until we know what's next. I agree with Alli's assessment. You do need to have some sort of protection in portfolios at this point. We have a lot of events ahead of us in 2020. We personally like having treasuries in a risk-on portfolio for the reasons that we think growth is starting to look marginally better, but having that protection in the portfolio makes sense as it acts as a hedge in these sorts of situations.
Treasuries had a pretty good year last year.
They
Do
did.
you expect that you can actually have that kind of gains this year as well?
Well, I don't see why not. It'll be harder to repeat the magnitude of the rally, but I think we can still see treasuries doing okay this year. We think first half of the year will be dominated by the improvement in global growth, and that might cap how much of a rally we see. But I think second half of the year, some of the tailwinds we've come into will be fading, and we actually think there's a very real possibility we could test the lows of 20.
You do?
Yes, we do.
Alli, what do you make of global growth and how that would play into looking at perhaps emerging markets or even some of the more China-directed plays now that we have a phase one deal we think that will be signed here shortly?
So let's assume that the phase one deal does go through. Relatively limited, relatively simple in terms of the issues it addresses. Emerging markets underperformed last year by about 10%, a meaningful amount. We see the headline risk. It's obviously there. Geopolitics are huge. We expected a strengthening U.S. dollar. It didn't happen. Again, I think those tailwinds are going to support emerging markets. Emerging markets usually trade at about a 30% discount to developed markets. Excuse me, a 20% discount. They're now trading at a 30% discount. The same kind of sentiment that we watch in the U.S. in terms of manufacturing and consumer sentiment has started to bottom there. And that's really where we see, especially in Asia, given that Asia represents sort of 70% of a lot of the emerging market capitalization. We do see growth. We do see movement there. And we actually added about 3% to portfolios middle of last month, actually before, like relatively in line with the trade deal. And we see that going forward. Now, it is going to be more volatile than, let's say, staying defensive in the U.S., but it's a much longer-term play. And while we expect relatively sort of mediated returns in the U.S. and developed markets, we do see a potential for outperformance there.
Diana, we've talked a bit about the Fed's balance sheet, particularly from October towards the end of the year, and how it seemed to equate with, as well, the rise in the equity markets. Do you expect that this non-quantitative easing, though we all kind of refer to it as that, will continue, and will it have an impact on the equity markets?
Well, it certainly trades like QE, and to the extent that there's a clear correlation between the number of reserves in the system and how risk assets are trading, we expect that will be a very strong technical support to the markets up until Q2, where the Fed has said this current program is due to run. That, coupled with the fundamental improvement, we think will actually be generally supportive of risk assets, barring an escalation on geopolitics.